All right, let's go. Thank you all for joining me. I know this is a very busy time of the year, but I also know it's one of those times when you just can't find the time to get the answers that you need. And that's what I'm hoping to do here today, to answer all those questions that you couldn't have gotten an answer to, and now you're up against the deadline. Or we can also talk about the upcoming IRA season. What are some of those questions that you're getting? And just in case it took a while to warm up, I included some slides of some general updates and reminders so that you can start submitting the questions as I review these slides quickly. And maybe they'll help you to think of some questions. Just remember, the first one is the new RMD tables. If you're calculating RMDs in this year 2022 and after, make sure you're using the new RMD tables. They're available in IRS publication 590B in the back, which is available at irs.gov. Just punch in publication 590B in Google and it pulls it right up. If you're using a good software, they likely have already been updated, but if you are brave enough to do these calculations manually, just make sure that you're using the new tables. Remember that proposed regulations on the new RMD regulations as provided under the Secure Act was published on February 24th. They have not yet been finalized, but for now, those are what we have to operate under, right? And one of the big changes that came out of those proposed regulations was if a designated beneficiary inherited an IRA from someone who died on or after the required beginning date, then they have to take annual RMDs. And all along we thought that was not the case. I get a lot of RMD questions for beneficiaries, and usually it's as simple as owner died on this date. What are the beneficiary options? If a client is asking you about distribution options for a beneficiary, this is the list of information that you need. You don't need to write this down. I'm going to send you a copy of my slides, right? So just to make sure you get all the information, because when you send it to me, I'm going to have to kick back the email and ask you a whole bunch of questions, or I'm going to have to give you a 2-page explanation that's just going to cloud the issue. So the more information that I get, the easier it is to provide the answer to your question. The required beginning date, we used to think it's no longer an issue for designated beneficiaries. Now we know it still applies. So that's one of the questions that you want to ask the account owner. What's the date of death of the account owner? What's the date of birth of the account owner? I mean, that's one of the questions you want to ask the beneficiary. And the objective is to determine if the account owner died before the required beginning date, because that is part of what drives your answer for the different classes of beneficiaries. Now, I know most of you know by now that we have a new class of beneficiary, an eligible designated beneficiary that was added effective 2020 under the Secure Act. So part of what we want to do is find out if a beneficiary is an eligible designated beneficiary so that we can determine if they're eligible for the exception to the 10-year rule. I hear a lot of talk that the stretch IRA is dead, and I like to say that it's on life support. But here's a tip. If the IRA owner or 401k participant died before 2020, and the beneficiary also died before 2020, then they are protected under the old stretch rules if the beneficiary had already been taking life expectancy distributions. What does this mean for you? It means that if a client tells you that they inherited an account, you want to find out if the client that is sitting in front of you is the original primary beneficiary or a successor beneficiary, because if they're a successor beneficiary, then they might still be eligible for the stretch if the beneficiary, original beneficiary died before 2020. RMDs for year of death. Find out if the account owner died on or after the required beginning date. And if they did, the question becomes, did they take the RMD for the year of death? Because if they didn't, the beneficiary has to take it. Now, here's some good news. Before the proposed regulations, we used to tell beneficiaries, you got to take it by the end of the year of death, or you're going to owe the IRS a 50% excise tax for not meeting that deadline. But the proposed regulations, one of the good things that came out of it is, hang on a second, let's give these people some time to do this because they're already dealing with the death of a loved one. So now they have until tax filing due date plus extension of the beneficiary to take the RMD for the year of death without being subject to the 50% excise tax. New rules for 72T distribution, you have seen the news. A lot of people are getting laid off. Many of them are young, younger than 59 and a half for sure. And some might have no choice but to take early distributions from their retirement account. And the question for you as an advisor is, can you help them avoid the 10% early distribution penalty? And sometimes you can. One of those options are 72T distributions. Of course, as you know, I always say, you don't recommend a 72T distribution without performing an analysis, because it has to be a good solution for your client before you want to trap them into that, because you're looking at 5 years or until age 59 and a half, whichever is longer. And if they're already hunting for a job and will likely soon get one, then they're not an ideal candidate for a 72T distribution. One of the things that came out of the proposed regulation is that the IRS pretty much admitted that, listen, we messed up. When the Secure Act was published, the language in the Secure Act said that if you're subject to the 10-year rule, then distributions are optional for years 1 through 9 until the end of year 10, right? Then afterwards, when they published the proposed regulations, they changed the language and said, it depends. If the account owner died on or after the required beginning date and the beneficiary is a designated beneficiary, it is true that they're subject to the 10-year rule as a maximum distribution period, yes. But guess what? If the account owner died on or after the required beginning date, or if it's a successor beneficiary where the original beneficiary was taking distributions over the life expectancy method, then that beneficiary has to take annual RMDs. And as you can expect, there was an uproar, right? And in response to that, the IRS issued notice 2022-53 and pretty much said, listen, we messed up. And because of that, anyone who's subject to the 10-year rule and is also required to take annual RMDs, we're waiving the 50% excise tax for any RMDs that they didn't take for 2021 and 2022. So that's some of my updates, and let me see what kind of questions have come in here. What is the likelihood of Secure Act 2.0 being passed this year? A lot of people with inside knowledge thinks that it's very likely that it's going to pass this year. Remember, Secure Act, the first Secure Act was passed on December 19, right? So we still have 3 days to beat that record. But if it does pass, I think that it's not going to be effective for this year. Like the first Secure Act, it could likely be effective for 2023, which is the next year. But like that too, I think there are some provisions that might not take effect until maybe 2024 to allow IRA custodians and plan trustees to update their systems to catch up. QCDs, if a check is written this month but does not clear until January 2023, how is it treated on 1099 and for tax returns? Doug, it depends. Now, there are two options here. If the IRA owner contacts the custodian and have the custodian issue the check from the IRA, then that's a 2022 distribution. It's going to be reported on a 2022 1099-R, right? So it's a 2022 QCD. Now, there are some custodians that allow their IRA owners check writing capabilities. And that's where we have a problem, because if the IRA owner has the checkbook and writes that check and delivers it to the charity, but the charity does not cash that check until 2023, then we have a 2023 transaction. So if your client has a checkbook capability for their IRA and they're using that to make a QCD, encourage them, walk over to the charity and hand it to the responsible person and say, listen, I'm holding you, I'm taking you to the bank, so you deposit that check now so it clears my account because I want it to be a QCD for this year. What happens if a beneficiary disclaims an IRA and there are no contingent beneficiaries? Well, in that case, we have to look at the terms of the IRA agreement to determine what the default provisions are, right? And then we're going to use those default provisions. This is why I like what I call estate planning friendly IRA agreements, where it would have language that says something like, if there's no IRA beneficiary, then the beneficiary is a surviving spouse. No surviving spouse, children per stirpees. No children, grandparents. And then if there's nobody, then it goes to the estate. So Ken, we're going to have to look at the terms of the IRA agreement to determine who then is the beneficiary, because now we don't have a beneficiary, right? If the primary disclaims and there's no contingent, which is why when a client says, I want to disclaim my inherited IRA, when you're advising them, the question becomes, well, when that happens, who's going to be the beneficiary, or what is going to be the beneficiary? Because then the answer to that might help the client decide whether or not they are going to disclaim. Inherited IRAs, inherited IRA beneficiary passes away before inherited IRA balance is exhausted. Does successor beneficiary use the original inherited IRA beneficiary's life expectancy for distributions? Comment on any difference pre and post 2020 death. Doug, do you want to be here all afternoon? So here's a short, this is the shortest I can make it, Doug. You want to look at the options that the original beneficiary was using, right? If the original beneficiary was taking distributions over their life expectancy, and that original primary beneficiary died before 2020, then the successor beneficiary continues taking that distributions over the life expectancy that apply to the original beneficiary. That's what I was talking about when I said the stretch is not really dead, because it depends on who we're talking about. So owner died before 2020, beneficiary died before 2020, and beneficiary was taking distributions over their life expectancy. Then the successor beneficiary continues that stretch over the original beneficiary's life expectancy. But if the beneficiary dies 2020 or after, the question becomes, was that beneficiary taking distributions over their life expectancy? If they were, then the successor beneficiary is subject to a 10-year rule, meaning they have to continue life expectancy distribution, and they can't do so for more than 10 years. If the original beneficiary had only, say, 5 years left, then that's all they have. But if the original beneficiary had 20 years left, then the successor beneficiary only have 10 years. If the original beneficiary was a designated beneficiary subject to the 5-year rule, let's say the original let me clarify that. If the original beneficiary was a designated beneficiary subject to the 10-year rule and they die, say, year 5, then the successor beneficiary only have 5 years left. So send me an email. I actually wrote up a summary on that, and it's in my IRA Quick Reference Guide booklet. That's available at IRApublications.com. Prospect transferred 401k to a new IRA account in April 2022. Wants to roll over 50% of assets now to another IRA before year end. What are major concerns about this request? So they went from a 401k to a new IRA in April 2022, which would mean that if there were any RMDs due from the 401k, they would have taken that RMD from the 401k. So we don't have an RMD issue here. Now, if they want to roll over those assets to a new IRA before year end, the first thing I'm going to recommend is, why do you want to use a rollover? Rollovers come with nothing but problems, right? But let's say they want to use the rollover. Then the only thing we need to find out is, was an RMD due from that IRA? Because if so, they got to take the RMD before the rollover, right? And did they already perform an IRA to IRA rollover during the preceding 12 months? Because if they did, they can't. For those reasons, I recommend doing a non-reportable trustee to trustee transfer between the two IRAs. So those are the only two concerns. This one says, hi, my hot Jamaican mama. This is my sister in Heather. If you convert an inherited qualified plan to an inherited Roth IRA and the client pay the taxes on the account, do the client need to take RMDs from the inherited account, or can that inherited Roth grow for 10 years and be emptied out at that point? Michelle, it depends on whether the beneficiary is a plain designated beneficiary, an eligible designated beneficiary, and whether the participant died before the required beginning date, right? This is what part of what I was talking about. You got to ask a whole bunch of questions to find out what the distribution options are for the beneficiary. Let me give you an example. Let's say the participant died before the required beginning date. They convert the amount to a Roth IRA. And actually, let me qualify something. We're talking about a Roth IRA, so there's no RMDs. There's no required beginning date issue for Roth IRAs. But if we're talking about an inherited 401k that's rolled over to a Roth IRA, the question becomes, is the beneficiary a designated beneficiary or an eligible designated beneficiary? If it's a plain designated beneficiary and the account owner died before the required beginning date, then the options are the 10-year rule. Distributions are optional until the end of year 10. But if the account owner died on or after the required beginning date, then distributions would be made over the 10-year period, but annual RMDs would be required. If it's an eligible designated beneficiary, then if the account owner died before the required beginning date, they can choose between the 10-year rule and the life expectancy rule. But if the account owner died on or after the required beginning date, then distributions would be made over the longer of the decedent's life expectancy or the beneficiary's life expectancy. Mom died in 2021, age 94, was taking RMDs and took RMDs in 2021. Adult son named as beneficiary. I know son must take annual RMDs over 10 years, but can he wait to take his first RMD until 2023 because of notice 2022-53? So that let me carefully word my response, because he still is subject to an RMD for 2022, but what happens if he doesn't take it, right? No consequences, whatever. So yeah, he can say, I'm not doing anything for 2022 because the IRS messed up with their language. So his first actual distribution can start in 2023. And the second part of your question is, do you start a calculation as 10 years from 2023? No, because that's a key. One of the key things that we need to think about for 2023 is that they didn't really waive RMDs. They just waived the 50% excise tax, right? So for someone who died in 2021, year 2022 is still year one, even though if they don't take it, there's no 50% excise tax. Inherited IRA in 2020, non-spouse beneficiary did not take RMD in 2021, 2022, using notice 2022-53. On the Secure Act, do they now have to take RMDs based on their life expectancy for the remaining 8 years? So died in 2020, non-spouse beneficiary did not take RMDs. We're assuming here that the account owner died on or after the required beginning date, right? Because that's the only time we have annual RMDs for a designated beneficiary. So again, which is one of the reasons we want to ask, what's the date of birth and date of death of the account owner? Because we want to make that determination. Now, if the account owner died before the required beginning date, the straight 10-year rule applies, distributions optional from years 1 through 9, gotta empty the account by the end of year 10. But if the account owner died on or after the required beginning date, then annual RMDs must be taken. But if they don't take it for 21 and 2022, there's no 50% excise tax. And yes, they must continue taking distributions over their life expectancy for the remaining 8 years. I bought your ebook in late November. I will review it for the inherited IRA you addressed. And session is helpful. Thank you, Doug. And if you have any questions about anything in that ebook, just shoot me an email and say, Denise, I bought your ebook. I'm asking you this question, so do not send me a bill because I bought your ebook. The father was taking RMDs from a qualified plan. Son inherits the account. Okay, let me go back and see which one this was about. Okay, so where RMDs have already begun, Michelle, the language in the proposed regulation says that the at least as rapidly rule still stands. And I think what you have landed on here, Michelle, is one of those areas where is it really clear or not? Because Michelle, as it's obvious that you know, for Roth IRAs, there's no required beginning date. So there's no issue of death occurring before or after the RMD. It's all death before the RMD when it comes to Roth IRAs. But the issue that complicates this, Michelle, is that the assets were in a traditional 401k or 401k period where RMDs have already begun. And part of the language in the proposed regulation says where RMDs have already begun, it can't stop. So that beneficiary must continue RMDs under the at least as rapidly rule. Michelle, please send me an email. This is very interesting and we need to continue this conversation. Is a Roth IRA contribution an after-tax contribution? Yes, Roth IRA contributions are made with funds that have already been taxed. Good news is earnings grow tax deferred, but they eventually become tax-free once the individual is eligible for a qualified distribution. Thank you, Michelle. Will the backdoor Roth IRA get repealed? The good news is not yet. Remember, there was this big talk after Peter Thiel's, the article came out about Peter Thiel's massive Roth IRA, and they published the Build Back Better Act bill, threatening to take away several provisions that were available to Roth IRAs, including the backdoor Roth IRA contribution. But for now, that's still available. So for your clients who have the very welcome problem of making too much money so they cannot make a contribution directly to a Roth IRA, they can still do a backdoor Roth IRA contribution. So still available. What is the real deal on taking RMDs for 2021 and 2022? Do beneficiaries have to take them? This is one of the most popular questions, obviously, you can see, right? If your client calls you and says, do I have to take RMDs? I inherited an account and hearing conflicting information. One of the things you want to do is see if the beneficiary is subject to the 10-year rule. If they're subject to the 10-year rule and also subject to the life expectancy rule, so you have that combination, then they qualify for the waiver of the 50% excise tax that applies to beneficiaries who do not take RMDs. What are your thoughts on paying your children, making them work for you, and making contributions to Roth IRAs? I do that. My son works for me, but you got to be careful because you can't be running an accounting firm and have a 5-year-old and say that the 5-year-old is helping you with the books. That won't fly with the IRS, right? But my son's 20 and he helps me call clients, he helps me file paperwork, little easy stuff that a 20-year-old can do. And so I have justification in paying him a reasonable salary. And then I take his salary or some of it and I put it in a Roth IRA. He gets his paycheck, does whatever he wants to do it, but the compensation is there to substantiate the contribution. So it's a good idea. You do that every year. Your kid might be a millionaire by the time they're 40, but just be careful to make sure it makes sense from the IRS perspective. Can someone roll over their simple IRA to a traditional IRA? It depends. As long as it has been at least 2 years since the first simple IRA contribution was made to that simple IRA, then yeah, they can roll it over to the simple IRA. But my sister in Heather, who's on the line with us, is probably thinking Denise is going to say to them, why do you want to do a rollover? Never do an IRA to IRA rollover when you can use the transfer method. Please trust me on this. IRA trustee to trustee transfer. And here's how you do an IRA trustee to trustee transfer. Client wants to go from custodian A to custodian B. Have the client go to custodian B and say, I want to transfer my IRA to you. Because then custodian B is going to set it up on their transfer system, and custodian B is going to go to custodian A on behalf of the client and ask for the transfer. Why don't you want the client to go to custodian A? Because every time that happens, the custodian A is going to say, oh, here's a distribution form. And the client's going to fill out a distribution form, gets a 1099-R, have 60 days to roll it over, and a mountain of things is going to go wrong. If you don't believe me, Google PLR, rollover, IRS says no. So always do a trustee to trustee transfer, right? There are going to be instances where the client might say, I need funds to use it on a temporary basis. So in those cases, yeah, they're going to take a distribution, roll it over within 60 days, but then they can only do that only once during a 12-month period. So now we have another issue. But if you ever have a client who's about to break the 1 per year IRA to IRA rollover rule, don't give up, because there are some solutions, like they can roll it to an employer plan instead, or they can do a Roth conversion. This is awesome. I'm glad that you're my sister from my countrywoman. Thank you. IRA, Michelle, appreciate that. I was told that I can only do one Roth conversion during a year. Is that true? No, that's not true. The only thing that you have a limitation on from a frequency perspective is doing an IRA to IRA rollover. And the bad news is that this is aggregated among all of your IRAs. So if someone takes a distribution from a traditional IRA and rolls it over to the same or another traditional IRA within 60 days, they're done. Even if they have Roth IRAs, SEP IRAs, simple IRAs, it doesn't matter, because all IRAs are aggregated and treated as one for this purpose. Another reason to encourage clients to use the trustee transfer method. I have some business owners who want to set up retirement plans, but don't want to make contributions for their employees. I hear that a lot, right? I'm already paying them a good salary. I want to fund my retirement account. Why should I have to fund theirs? Well, because the tax code says so. The tax code is written so that the business owner can't say, I want to make contributions for myself and exclude my employees. Now, when I hear that, when a client calls me and say, Denise, this is what my client who's a small business owner wants. That's when I do a profile for the small business owner, because there are some instances where you can exclude employees. Had a recent case with a business owner who owned a franchise and hired high school kids every year. Those high school kids never stayed for more than 1 year, and sometimes not for more than a few months, right? So based on that and other factors that determine suitability for the client, a SEP IRA was the ideal plan. Why? Because you can say, if you haven't worked for 3 of the 5 preceding years, then you're not going to get a contribution. And if the business owner have had the plan for more than 3 years, then the business owner is automatically covered. My client keeps making a simple contribution at year end. Can they do that? Is that legit? Yeah. Now, there are 2 types of contributions that are made to simple IRAs. Salary deferral, which is taken from the employee's paycheck. And the Department of Labor says, if you take your employee's money from their paycheck, you cannot hold on to it past the 30th of the following month. So you take it out in December, it's got to be in the employee's account by the 30th of January, right? But for the employer contributions, those can be made by tax filing due date plus extension. So find out what type of contribution that is that your client is sending in, and just make sure you explain to them what the rules are. What if the business owner wants to contribute more for himself to his SEP IRA? Can they do that? It depends. Most small business owners uses the IRS model Form 5305 SEP agreement, right? If you go on the IRS website and type in Form 5305 SEP, it pops up. Some custodians will use it and put their logo on it. Same thing. Now, if they use that, contributions have to be made on a pro rata basis, which means if the employer makes a contribution of 10% for themselves, then every employee has to receive a contribution at 10%. But there are some custodians who offer prototype agreements that allow different types of contributions. For instance, some allow a flat dollar, some allow Social Security integration. So if it's important enough to the business owner, then you want to check to see if you can find a custodian with a prototype. Now, the Social Security integration formula takes the approach that when you make contributions to Social Security, it stops at the Social Security taxable wage base, right? So anyone who earns above that is sort of at a disadvantage when it comes to making contributions, because they're getting a smaller percentage, and the Social Security integration allows them to make up for that. Please talk about an IRA with a trust as the beneficiary, death after December 31st, 2019. That a lot of changes have been made there too, Nancy. Now, there are certain rules that have still been retained. For instance, is the trust a qualified see-through trust or not, which would make it a designated beneficiary? But there are also special provisions where if the trust meets certain requirements, like if the trust has a minor child of the account owner as the beneficiary, then the trust could be an eligible designated beneficiary. And those are going to drive the distribution options. But it gets more complicated than that, Nancy. There's a whole lot of other stuff that has been added. So please send me an email and I'll tell you some of what those are. I will admit though, when it comes to trust beneficiaries and I get certain questions, I like to refer clients to an attorney just to be sure, but I can answer general high-level questions and stay in the area that won't get me in trouble where I have an attorney sending me an email saying, you're practicing law and I'm gonna get you in trouble. So I gotta be careful. Now that the RMD age has been increased to 72, Does my client have to wait until age 72 to do a qualified charitable distribution? No. The QCD, or qualified charitable distribution age, is still age 70 and a half. So as long as your client is at least age 70 and a half, they can do a QCD from their traditional IRA, their Roth IRA, including beneficiary IRAs. Now remember, they can't do a QCD from an ongoing SEP or simple. What does that mean? It means that if a SEP or simple contribution is made to a SEP or simple for that year, then you cannot do a QCD for that year. Here's another reminder about QCDs. Let me do a 30-second background for those who might not be familiar with QCDs. Under the QCD rule, qualified charitable distribution, an individual who is at least age 70 and a half on the day that the distribution is done can treat that distribution as a qualified charitable distribution. It's capped at $100,000 per person per year. The check has to be made payable to an eligible charity. So while it can be delivered to the IRA owner, for them to deliver it to the charity, it has to be made payable to the charity. Now, when the Secure Act was passed into law, part of the provisions include repealing the age limit on traditional IRA contributions. So now you could have anyone making contributions to traditional IRAs regardless of their age. And what Congress realized is that you could now have someone making a QCD and making a deductible traditional IRA contributions at the same time. So they could be double dipping. They implemented a provision that says you cannot double dip. So let's say, for example, you made a QCD of $100,000. Before 2020, all of that would be excluded from income. After 2020, now we got to ask that client, hang on a second, did you make a deductible traditional IRA contribution too? Because let's say you made a deductible traditional IRA contribution of $5,000, then only $95,000 would be excluded from income, right? So now we have a whole lot more things to keep track of as we have conversations with these clients about these transactions. Please keep the questions coming. Why would anyone want to name an estate or trust as an IRA beneficiary? I assume if they have no one they could name as a beneficiary, it depends. There are, if they have no one to name as beneficiary, they could name the estate. That's one of the reasons. But the question then becomes, who's going to inherit the estate, right? Most times when I see an estate as a beneficiary, it's due to an oversight. Someone might have named their wife as their beneficiary. Their wife died, and they did not name a replacement beneficiary. And under the terms of the IRA agreement, the estate is the default beneficiary. Then Houston, we have a problem because now we have that limited distribution options, right? As far as a trust beneficiary, sometimes an IRA owner might say, listen, after they're gone, they still want to have that control from beyond the grave. I don't want you to take my money and go have a party with it in year one. So I'm going to name a trust as a beneficiary, and I'm going to include some provisions in the trust that says something like, okay, you're my second wife. I know you don't like my kids from my first wife. So here's what I'm going to do. You get an income, and until your death, then the rest goes to my kids, right? Or they might say, this is for a beneficiary that I know is going to spend it all. Let's make sure that some is used for education, some is used for so on and so forth. So there are different reasons. Now, what I usually say when someone asks me, should I name a trust as a beneficiary? Well, you want to have a conversation with your estate planning attorney, but you also want to have the attorney understand the limitations, because here's a lot of what I see happening. A trust is named as a beneficiary, and when you look at the terms of the trust, there are no restrictions whatsoever. There's no tax planning benefit, nothing. So it doesn't make sense. And then now you have the beneficiary of the trust going to the IRA custodian to say, there's no limitations on the trust. I have complete discretion. Can you just move it to my beneficiary IRA under my name and social? And some custodians will accommodate that request, some won't. And if they won't, then you have the beneficiary of the trust having to go to the IRS to get a private little ruling. And in most cases, in those instances, the IRS will approve it. But here's the thing, the IRS is going to charge $12,500 to review the private little ruling request. And that $12,500 is owed whether or not they approve the request. And most clients cannot do it on their own. So they're going to have to hire someone, to help them with it, some professional, and the professional is going to charge fees ranging from $20,000 to, however much. So it's a good question, and clients should really carefully consider whether naming a trust beneficiary makes sense for that particular client. On the issue of estate beneficiary too, Doug, I always recommend that clients review their beneficiary designations at least once per year. And whenever there's a life-changing event, someone dies, there's a new addition to the family, whether by birth or adoption, someone got married, review your beneficiary designation form, because it's likely that this change in family makeup will necessitate an update to the beneficiary form. I'm seeing too many instances where people are disinheriting their beneficiaries because they didn't take the time to update their beneficiary forms. Would you recommend a solo K for a small business owner? It depends. A solo K is a 401k without all the trappings of non-discrimination testing. Why? Because the only people who are eligible to participate in the plan are the business owners, which includes business owner, their spouses. If you have a partnership or partners of the partnership, no common law employees. So in that case, a solo K might be suitable, but you have to look at other factors. How old are the business owners? If they're under age 50 and they make enough money so that they can maximize contributions without having to do salary deferral contributions, then maybe they don't need a solo K. So there's never an easy answer to which retirement plan is most suitable for a small business owner. And we're coming up to tax season now. Here's what I usually see happening during tax season. The business owner is having your tax return done by the tax preparer, and the tax preparer says, wow, you made a lot of money last year. You need to shelter some from income taxes. How about we set up a 401k for you, or a SEP IRA? And the business owner says, yeah. Then they go to the financial advisor to set up the retirement plan. And no one says to the business owner, do you have employees? Do you have ownership in any other businesses? Because if so, then those employees of the current business and your other business might need to be covered as well. And because no one is asking those questions, then 5-10 years later, someone like one of you advisors who are on the line now will say to them, well, what about your employees? And then you find out that employees you should have been covered for 10 years ago, for every year for 10 years ago, were not covered. Can you imagine the nightmare of having to make those contributions for all those years plus interest? Wife more than 10 years younger. If you set up a SLAT, can you use the longer life expectancy for RMDs of the older IRA owner? Generally speaking, when the spouse is the sole beneficiary of a trust and the trust is a qualified see-through trust, then the distribution options are the same for the most part as those that would apply if the spouse had been named directly on the beneficiary form as the beneficiary. So the question becomes, is the spouse the sole primary beneficiary, and if is the trust a qualified see-through trust? You guys have some great questions. Let me see, got an email here. how does the IRS know if someone is supposed to take an RMD? Well, the IRA custodian is required to issue Form 5498 for an IRA and indicate if an RMD is due for that year. So that's one of the ways that the IRS knows, right? But this only applies to retirement account owners, or IRA owners, I should say. So traditional SEP and simple IRA owners, that requirement does not apply to anyone else. I'm getting a lot of complaints from customers where IRA custodians are being nice enough to do calculations for beneficiary IRAs. And when you look at how complex a beneficiary IRA is, I know that makes the customers happy. But here's what the IRA custodians are not doing. See that first slide that I showed you earlier? They're not asking them, were there multiple beneficiaries on the account? And if so, were any of those a non-person beneficiary? And if so, would the non-person beneficiary take a full distribution by September 30th of the year following the year of death, right? Are you a successor beneficiary, or are you the original primary beneficiary? Answers to these questions will determine what the distribution options are. And these very nice custodians are only asking beneficiaries, what is your date of birth? and they're assuming that these beneficiaries should take distributions over their life expectancy, and in many cases, to fully distribute the account within 10 years. And that's not always the case. No, I'm not saying that this is the case with all custodians, but those so far where customers have asked me to review the calculations, that's what I'm finding. So what should you do as an advisor? Well, I'm going to send you a copy of the presentation today, and on that slide, you'll see the list of information that you need to get from your customer to make sure you tell them what their distribution options are. We still have 12 minutes. Come on, I need more questions. Okay, here's one. A small business owner changes from a SEP to a 401k. Can they just stop funding the SEP and fund the 401k? Yeah. When it comes to a SEP IRA, there's no formal termination process. So they can just stop funding the SEP IRA, notify employees that the SEP IRA will be discontinued, and then start with the 401k. You don't want to fund the 401k and the simple IRA, the 401k and the SEP IRA in the same year, unless the SEP document is a prototype or individually designed document. Because the IRS model form 5305 SEP agreement that I talked about earlier cannot be used if the employer maintains any other retirement plan. Now I have some other slides here that I want to go through until you guys ask me more questions. This is a very important case. And I talked about earlier, I mentioned that I recommend reviewing the beneficiary form each year. But you know what? Updating your beneficiary form doesn't mean anything if it's not done right. And I have a list of a checklist for beneficiary designation forms. And one of them is as simple as you got to make sure the percentage adds up to 100%. Now, this is for an insurance policy, but this also applies to IRAs. In this case, the policy owner updated the beneficiary form, and the percentage allocated to each beneficiary did not add up to 100. And so when the policy owner died and those beneficiaries went to claim their benefits, the issuer said, no, the old beneficiary form that was on file before this one, that's the one we have to use, because the new form was rejected because it didn't add up to 100. Can you believe that? Now, this is a huge one, right? When a client says to you, I want to roll over my retirement account. Let's assume it's a 401k. They want to roll it over to an IRA. part of what we have to do is make sure that the amount is in fact rollover eligible. The plan administrator is required to let participants know if an amount is eligible to be rolled over. The same thing when a client says, I want to roll over my traditional IRA to another traditional IRA with you. You got to find out, are they breaking the 1 per year IRA to IRA rollover rule? Because if they are, that rollover is going to be invalid. What happens when you have a rollover of an amount that's invalid or ineligible? Well, it creates an excess contribution in that receiving IRA, right? And now if that excess contribution is in excess of the individual's regular traditional IRA contribution limit, which is only $6,000 for some, plus catch-up contributions for those who are at least age 50 by the end of the year, then we have a huge problem. Look at this. This costs this taxpayer over $8 million in excise taxes because they didn't have an advisor who does an IRA audit every year to see, well, what's going on? Did you make a mistake? Let's fix it. When your clients have IRAs with large enough balances, it makes sense to do an IRA audit. Because if they'd done an IRA audit for this IRA, they would have caught it. And this person now wouldn't have to pay the IRS over $8 million. Where does this $8 million come from? If someone makes an excess contribution to an IRA, they're required to correct that excess contribution by their tax filing due date plus extension. And simply taking it out is not a correction. You have to follow IRS requirements, which includes having the excess correction be accompanied by any net income attributable to the amount. So what happens if you don't fix that by your tax filing due date plus extension? Then the amount is subject to an excise tax of 6% for every year it stays in that IRA. So, you know, I don't know about you, but I wouldn't want to be the advisor who's having this conversation with this IRA owner. So just remember to do IRA audits for your clients. Well, we talked about the 10-year rule already. Does anyone have any questions about that? You guys were great. These were some fantastic questions. Hope you don't mind me pushing a little bit, but what some of you have asked me for is, how do I communicate with clients, right? And sometimes you want to do a little meeting with a client, sometimes you want to just write a letter. And part of what I provide for people who need it is quarterly client communications that is paired with PAIRED, paired with explanations that I provide to you. So I'll give you an advisor explanation, and I'll also give you a letter that you can share with the client that says, this is what's happening here, some of the things that you need to think about. The next one that's coming out is on the new 72T rules, but I also have some that are still current that talks about beneficiary options, etc., and how to do a beneficiary IRA checkup. And I add at least one every quarter, right? If something new comes up, then I add that as well. And I have an IRA shop where I sell IRA stuff. That's where the gentleman bought my IRA book. More questions? Thank you, Keith. Appreciate it. Address DOL rules for transfers to 401ks. Oh, Doug, that is such a great topic. I am going to be doing a webinar on that, and I'm going to be bringing in an expert, right? Because there are some rules that I would like an attorney to address. So I'm going to be talking about that as well. Very important topic, because I think TIA-CREF got into a whole lot of trouble because they did a whole lot of rollovers and didn't follow the DOL rules. So thank you for that suggestion. I'm going to be doing a topic in that. Well, 5 minutes left. I'll wait until the end of the hour to see if you have any questions, but you guys have been a terrific audience. These questions were fantastic, man. Great questions. I should do this more often, right? So I'll wait until the end of the hour to see if anyone think of anything else. Appreciate you guys' time. I know it's the busy time of the year, so I appreciate you spending an hour with me. Can an Uber driver set up a SEP IRA? Yeah, because they're self-employed, right? But of course, the question is the SEP IRA the ideal retirement plan for the Uber driver? There are a lot of self-employed individuals. Now, we're calling them gig workers. And a lot of them don't have any retirement plans, right? Because they're not working for big corporations. So they need to set up these retirement plans to help secure a financially secured retirement. But yeah, an Uber driver can set up a SEP IRA, but the question that we need to ask is that the most suitable retirement plan for that Uber driver? I must say that a SEP IRA is my favorite starter plan for a small business owner. So probably a good plan to start with. Can you have a 401k for one business and a simple IRA for another business? Great question. It depends. If the businesses are not part of a controlled group of companies, then yes, which is why I said earlier, when you're setting up a retirement plan for a small business owner, you want to ask, do you have ownership in any other businesses? And if the answer is yes, the question is, well, what's the percentage of ownership? Because you want to determine if the businesses are part of a controlled group of companies. Now, if you own company A that does financial advice, and you own company B that makes car parts, and you own 100%, then you cannot do a simple for one or a simple for the other unless the other is set up on some sort of collective bargaining agreement. But generally speaking, both businesses that are part of a control group of companies or affiliated service group, both companies are treated as one employer for retirement plan purposes. Excellent question. So as with many things that has to do with retirement plans, the answer is it depends. Any more questions? You're doing a fabulous job. Thank you. Nancy, you said over age 72. Oh, what are the 401k still working distribution rules over age 72? It depends, Nancy. The tax code and the regulation says if you're in a 401k and you're still working, you don't have to take RMDs until you retire. So you can wait until past age 72. But here's the thing. The plan administrator can say, I don't want none of that. You're 72, you got to start taking RMDs. So don't assume that because the client's still working, that their RMDs deferred. Check with the plan administrator. Also, if that participant owns more than 5% of the business, they have to start taking RMDs. The option to defer past 72 is not available to a 5% owner, which means someone who owns more than 5% of the business. Thank you, Sheridan. Thank you, Doug. Thank you. Thank you, everyone. You guys are great. 12:59. I will do this again, and I hope to see you around next time. Happy holidays, everybody. You're welcome, Nancy. Remember to tell about your ebook and if there are incentives to purchase by listening to this wonderful webinar. Your speech and distinction and voice are terrific. Thank you, Sheridan. I'm going to send out a link to the ebook, and I'm going to include a coupon that people who attend this webinar can use, so you'll get a discount. Enjoy your sorrel and rum cake. Yes, Michelle. And enjoy your sorrel and rum cake too. Welcome. 1 p.m. Happy holidays, everyone.